Hello and a warm welcome to Money Manager. I'm Gugulethu Cele, standing in for Lindsay Williams this evening. Today we speak to Darryl. He's a portfolio manager at Anchor Capital to tell us more about a unique fund that you have. Maybe if you can walk us through it. It is the Baobab BCI Flexible Opportunity Fund.
Yeah, that's right. And as the name suggests, it's in the multi-asset flexible fund class. So I suppose in many instances an asset allocation class, but delving more deeply into the past of the fund, we focused quite heavily on equities because equities as well as listed properties in that group have been asset classes of choice in the Anchor investment team for some time, and so far so good. It's a two-year-old fund, so the track record is still relatively short. It's still small on a relative basis, although growing quite quickly, which we're thrilled by. And yeah, performance has been good. Investors have been well rewarded for taking a risk on a relatively small fund from an early age.
And mentioning risk, this does sit in the medium to high kind of risk classification. So who's the average investor that this kind of fund would speak to?
Well, I'd say, obviously it's not a Regulation 28 fund, so there aren't restrictions from an asset allocation point of view. I would say the type of investor that it has attracted up until now has been an investor with a slightly longer time horizon. So I'd say a little bit further away from retirement than someone who's retiring in the next 5 years, someone who's willing to take on a little bit more risk because it has been more heavily skewed towards equities and for the immediate future will continue to be so. So yeah, I'd say someone with just, as you say, a moderate to high level of risk tolerance.
Let's touch on that performance. You mentioned that over the last 2 years it has managed to reach great expectations and it's actually outperformed the benchmark quite substantially.
Yeah, obviously the benchmark is a combination between the SWIX, LB, Steffi, and as well as some of the MSCI World. With the heavy equity weighting, you would expect, given what's happened in the market over the last 2 years, that it would have outperformed its benchmark. But we're quite proud to say that it's significantly outperformed the SWIX, equity-only benchmark as well. So given the weighting on a more like-for-like comparison, it has outperformed quite substantially over the 2-year short track record.
And speaking of equities, just more than 50% of this, the allocation here is on domestic funds. And I'm impressed by some of the heavy hitters that you have in your fund, the top holdings, the likes of Aspen, Anchor Capital and Discovery Holdings. All three are companies that have managed to perform quite substantially over the last few years, as you mentioned.
Yeah, absolutely. So, obviously within a fund, it's, as I keep talking about the relative small size of the fund, it's growing quickly, but it is still small in the grander scheme of things. That doesn't mean that we fill the fund with small and mid-cap opportunities. We focus very much on quality. Liquidity is a key constraint when selecting underlying holdings, and you're absolutely right. We've been well rewarded by investing away from the benchmark with the likes of Aspen, with Investec, with Mediclinic, where we have a high level of conviction in a share. We're willing to up that weighting a little bit, and that's paid off handsomely up until now. Of the smaller cap counters that you've spoken about, bearing in mind liquidity is a key constraint, we try and limit small to mid cap counters to anything between 10–20%, no more than 10% at any given time.
Just on the liquidity as well, we have seen a significant pullback, especially on our local market performance. Does this play any kind of influence, obviously, in your investment making decisions?
Well, it absolutely does. In fact, if you look at the performance of the fund, it really only took off on a relative basis coming out of September, October last year, which, if you recall, will be the last time that the local market got the jitters and sold off quite quickly in a short space of time. And, it really... You look at your holdings, you try and up the quality of the counters that you hold, you reassess what you're holding, have things changed, is the market still favorable to the shares that you're holding? And we took off the return certainly out of the dip last time, and with the benefit of flows and some fresh ammo, we've been doing the same over the last week or so, looking to bump the quality counters that have sold off a little bit over the last few weeks and that still offer decent long-term prospects.
Having said that though, Darryl, what's your view on valuations? The likes of Naspers, either you love it or you don't like it, or you own it purely because of the growth opportunities that are presented there.
Well, the valuation is eye-watering. You're looking at a forward 35 times PE multiple, roughly in line with obviously what the major underlying investment Tencent trades at. But we can forecast some decent, or what has to be better than decent, growth out of Tencent for the immediate future, because that's the main driver of Naspers. And then you hear a lot about investors talking about the rump of the investment and that you're getting the rump for free or it's trading in negative territories. And Naspers is spending 7, 8, 9 billion rand a year in growing their e-commerce businesses, overseas, in Eastern Europe, in Brazil, in India, and places like that. When that spend switches off, it drops straight to the bottom line and they start to gain market leadership in those markets. So I still think, or we still think, that Naspers offers compelling long-term value, and I'm terrified to call it value because some of the value fund managers would probably shoot me as I walked out of the building for calling it that.
We certainly hope not.
But we still see good long-term returns for investors from the share.
Something else value investors like is resources, which clearly is not a common feature in this particular fund. Why aren't you a fan?
So absolutely. I think that the biggest, what speaks to the performance of the fund the most up until now has been sector allocation. And if you look at the returns amongst fund managers, particularly equity fund managers in 2014, the returns were diverse. You had those that owned resources and those that didn't. And clearly those that didn't own resources had quite a good year out of 2014 versus those that did. And to be honest with you, Gugu, we haven't owned resources in the fund. We haven't been tempted to buy resources this year, although you have seen sharp spikes and then subsequent sell-offs in resources because, quite frankly, we haven't seen any uptick in the underlying commodity prices. And until we see a compelling reason or some sustained evidence of an uptick in or an uplift in the underlying commodity prices, we aren't tempted into the resource stocks just yet.
So you're not a fan of resources, but maybe given the ongoing market flows that we're seeing, are you looking to beef up your holding, especially on the offshore equities market space? Yeah,
so we've had quite a high offshore equity weighting up until now, roughly around anything between 15 and the maximum 25%. As you go offshore, your choice is just incredibly vast. So not only is your choice vast, but in line with that, the valuations on some of these quality offshore counters are a fair amount cheaper than the South African counterparts. So we retain a 20% plus weighting to offshore equities. I've mentioned the maximum limit of 25%, and that's really boosted returns in the fund as well. We've made good money in hard currency out of the likes of Apple, out of Blackstone, out of more recently Starbucks, and out of a lesser known jewelry maker called Pandora, if you can believe that.
Oh yes, they do the bracelets, don't they?
Absolutely do, yeah.
A company that I've become familiar with thanks to one of your colleagues at Anchor Capital.
Oh really? Yeah, no. Sean Ashton, our Chief Investment Officer, spotted that opportunity a couple of years ago, and credit to him, it's paid off nicely.
But just having said that, how difficult is it now to find some kind of opportunities of real value? As we've touched on very briefly, markets going through slight turmoil, a domestic market not looking too optimistic, offshore's looking slightly more attractive. But like you say, you really need to hunt for those opportunities of value. Other than liquidity flows, what else do you look for before putting your money into a company?
Well, I would say long-term sustainability of earnings growth is probably the most important aspect that we look at. Valuation is incredibly important, but valuation unwinds incredibly quickly if you can sustain a good earnings growth looking forward. So we back the management team. In most instances, management teams that are tried and tested have been for many years, whether they be local or abroad. Valuation is a key determinant of what we select, but I'd say good returns on capital, strong cash flows, earnings growth years out. It's not easy to pick a lot of the time, and obviously you can get it wrong, and especially when you're investing in the offshore markets, that report quarter by quarter, and the hedge fund industry overseas is brutal. Now you get a company that misses their earnings expectations by 1 or 2%, and it opens 20% down. So our role as fund managers is to look through the short-term noise, to constantly reassess what we hold, why we hold it, and the market changes quickly at the moment. And is changing quickly at the moment. So I absolutely agree with you. The local market particularly is on the expensive side of history. There's no doubt about it. But within that, there are definitely still opportunities at decent valuations.
Are you looking to maintain this investment philosophy, or maybe nip and tuck it and tweak it as you go along over the short to medium term?
Our investment approach is very pragmatic. We have a particular style. Which stems from the investment, the guys sitting in the team. Would we be dogmatic about the way that we invest? Absolutely not. We haven't liked resources up until now, but we're aware of the fact that our competitors and some of our peers do like resources, and they hold resources, and resources make up a relative chunk of the SWIX index, the benchmark that we follow. So if the underlying core fundamental view on commodity prices changes, we'll own resource shares. For now, it doesn't look very likely though.
So following and adapting as the markets change naturally.
Yeah.
To come back to the kind of typical client and investor who would want a particular product like this, you've touched on the fact that it needs to be someone who has some kind of risk appetite. But
Yeah.
how can they get in touch with you and follow the progress?
So the type of investor that's been attracted to our businesses, Baobab or Anchor Capital, has been the private client largely. They are private client asset management businesses, although Anchor Capital being a little bit ahead in the track record are starting to attract some institutional flows as well. The business models are very tailored. You know, in our game, it's a simple process. At the end of the day, you produce consistent peer and market beating returns and give a great service on the side of that. It's actually very difficult to fail. So it's something both businesses focus on heavily. And how do they get in contact? Well, Baobab Capital or Anchor Capital on the website, in this instance Baobab Capital, and you know the necessary applications or contact details are there. Investors or potential investors are welcome to contact myself, or Ilandre Fourie is the CEO of Baobab Capital as well.
And it's a really affordable medium to get into. 500 Rand a month or 10,000 Rand lump sum?
It absolutely is. There are no barriers to entry, and you know that's why you know collective investment schemes are there. You know, to cater for the student, someone looking to build a long-term investment for retirement, or to cater for the private client that wants to invest in a fund that you know is hopefully tomorrow's hero, you know, tomorrow's couple of billion rand fund. Because you know while funds are growing, and if you manage to align yourself with a management team that is proven, you know, has a proven ability to pick shares and to pick the right stocks in the right cycles, then you can make decent money along the way.
Well, we certainly hope so. Darryl, we definitely look forward to keeping in touch with you and getting an update on the performance of this particular fund. More details on the company's websites, as Darryl has alluded to, if you want to get in touch with them. Well, that's where we leave it for Money Manager this